All right, guys. So today is the Fed rate hike decision. Yeah, it's one of the biggest events of market activity. So yeah, today is the Fed decision. Market is flying back up. I see. I see. What's his name thinks we're gonna have a pause. Kramer. Kramer thinks we're gonna pause. I disagree. I don't think that's ever gonna happen. But Kramer thinks we're going to pause today. Again, I disagree. I don't think there's any way we pause today, but maybe he's right. And again, I think this will be a really interesting tell in terms of Kramer's accuracy lately. I'm checking the different economic calendars. Most people are expecting uh, 25 basis point rate hike, and so if Kramer is right here, it will be shocking. So if Kramer's correct, it will be interesting because maybe that marks the end of Kramer's curse. And again, we'll see. Who knows? Um, but yeah, again, I think last time I checked, it was like 80 something percent of people think we're gonna do 25 basis points. All right, I got myself some green tea. Yesterday, dude, it was midday and I drank too much coffee and I was like jittery after the stream. Yeah, I think it's possible. I think for sure, uh, Meat World. I think it's certainly possible, but I think it's unlikely. But again, Kramer tends to think that we're going to, and maybe you're right. You could be right. Again, I have no idea what we're going to do today. And again, what I will say is this: if Kramer is right today and we do pause, the market will probably go up, and it might spell the end of the Kramer curse. So we'll see. Kramer, this is what Kramer said. Let me show you guys. Kramer said, or maybe it was a fake post. Maybe it was a fake post. It's so hard now to tell. Okay, so maybe Kramer didn't say anything. It looks like maybe it was fake. I saw maybe it was let me see. It was either inverse Kramer or it could be not Jerome Powell. All right. It's fake. Jim never posted. Okay, gotcha. Yeah. I was going to say if he was right, which is super unlikely that he's right, but if he's right, then, maybe it spells the end of the Kramer curse. Again, I really don't know. Um, yeah, we'll see. Yeah, maybe. What is your leverage? PacWest fails today before 2 p.m. I bet we pause. Let me see. What's PacWest is PACW, right? I don't know. I mean, it's stayed neutral today. I think it'll be influenced by the rate hike decision as well here. Um, so yeah, I think it'll be influenced by the rate hike decision as well. We got about 50 minutes left. All right, let's do a poll. Everybody's shorting Meta. Do you think expected 25 basis points to have a bullish or bearish effect? I don't know. I think that's a good question to ask here in our poll. So I'm going to do the poll now. So I think it's a good question to ask here. So we're going to go ahead and ask that. I think I'm going to do a poll. If we come in at the 25 basis point expectation, does the market react positively or negatively to that result? Or positively or negatively, question mark. Bull reaction, bear reaction. And then we'll also have another option for neutral reaction. There we go. Vote on that poll. Let me know. SPY is still green on the day. Gap it up. It closed at about 411, a little bit under 411. Yeah, a lot of people talking about Meta today. Meta was up so much, though, in the last, 6 months, though. Oh, wow. Yeah, y'all ain't lying, though, man. Look at Meta. Wow. Check this out, guys. Look at Meta. Down to 234s here. Let's see. Let's talk about this. FTC proposed a blanket prohibition preventing Facebook from monetizing youth data. Oh, man. I wonder how that affects YouTube as well. If JP comes in 25 basis points talking about more work to do, we're in trouble. I mean, yeah, for sure. But I think we're also kind of in a neutral position here today. All right. So I think inflation is still high. And you better believe he's going to say inflation is still elevated. Yeah. And so he says it at least once a press conference. You better believe he's going to say inflation is still elevated. With that, inflation is still high. But after these newly, sparked bank problems and fears over the last couple months, we're also having recession fears now, and they have a negative correlation with each other. So what's good for inflation is bad for recession worries, and what's good for recession is bad for inflation. And so there's an inverse correlation and relationship there. Now, if he pauses, what it's going to mean is continued. I think these headphones are going out. I'm going to switch headphones to these other ones. What it means, if he pauses, what it means is that it could spell trouble for inflation problems. And I think that's the way a lot of people are looking at it. Again, Meta shares are trading lower after FTC proposed a blanket. So that is what is going on right now. Let me stop the screen. Tell me if you can hear the music now. I'm also going to have one of my mortgage buddies coming on the stream today to talk about mortgages, kind of what the market is looking like there, and some other good stuff. So the time is we got a timer. The announcement is at 2 p.m. The press conference is going to be at 2:30. You can see Meta bouncing back a little bit from that. Dovish, we'll see. There we go. And so, yeah, he's breaking stuff, though. A pause could be just assessing bank landscape if messaged right. Yeah, I think, I think we're in some weird situation where we're fearing recession and inflation problems. And so I think continuing on as expected is the likely outcome here. Generally, I cover almost every rate hike decision. I've covered every one over the last year or so, for the most part. Typically, they come in as expected. And right now, 90% roughly are expecting 25 basis point rate hike decision today. So, you know, such a big number difference there. It's just such a big difference there. I got liquidated 3 times today. That's risky, man. Elevator going down, maybe. Again, I'm not really holding anything major in terms of swing trading. I tried to buy Carl Icahns' company IEP today and ended up selling because it just tanked down. And it looks like it was the right move. It kept on dropping down to 3280s. But yeah, small orders. Yeah, I mean, do you guys think Apple earnings will be good or bad? I really have no idea. I think I have to look at the graph of earnings. I mean, I think you can get some prediction from looking at historicals with Apple. And maybe economic data might influence. I have a habit of saying economical data. It's economic data, but we'll see if the economic data comes in good or bad today. What matters more so than the actual rate hike decision, because again, regardless of what anybody thinks, the rate hike decision will almost certainly be 25 basis points today. With that, what's going to matter more so than the actual rate hike decision will be what he says during the actual press conference. Like, that's going to matter more than anything else, I think, today, especially if we do come in at the expected 25 basis point number. And so I think if you're, again, I'm going to preface it with, like, I have no idea what's going to happen. No idea if we get good or bad data today. No idea if we get good or bad reactions to it. But the more likely outcome is a 25 basis point rate hike. And then it depends on what he says during the actual conference. That is going to matter a lot. What he says is going to mean a lot. And so that's something to pay, with special attention to, because that's going to, whether he's dovish or hawkish or bullish or bearish or optimistic with regards to inflation or optimistic with regards to a recession, that's what's going to matter the most here, I think. And I think the most likely outcome will be a 25 basis point rate hike. Again, I've been right about the last few. I don't know if we're right about this one. Again, I could be wrong. I'm not always going to be right. But yeah. Also, guys, if you guys want to join, be a part of our newsletter, we got hundreds in our newsletter. You can join our newsletter here. I will put the link to sign up. It's completely free. It doesn't cost a thing. And you can join it, and we're going to send out the kind of links. We send out the links to all the big reports, the big stuff. Each one. And we're getting ready to send that out now. Again, you can see Meta starting to rebound. SPY still testing the top of this range up here. Again, do me a favor, hit the like button as well. Let's try to get over 100 likes. We still got like 45 minutes until the actual report goes live, until the actual decision comes out. But yeah, hit the subscribe button, help support the channel here. We appreciate it. All right, so we are sending out this now. Again, Meta starting to bounce back some. Sending that out now too. Yeah, I'll show you guys how to get it, JB. All right, guys. All right, guys. So yeah, we got the SPY testing up these levels. And all right, guys. So again, we're at 412s right now. Meta bouncing back after a proposed FTC ban on some stuff. And again, we got Meta bouncing back up a little bit here. Starting to move up a little bit. IEP, Carl Icahns company, still dipping down some. Again, Meta at 236.40s, 236.40s. Every trade to open already starts crazy in the minus. How do you even trade so fast? Well, it depends on what you're trading. It's really just kind of a conditioning thing. It's like Pavlov and the dogs. You know, you just kind of, you be the dogs in that situation, and you be Pavlov as well. And you just kind of do the same things over and over again until you become more comfortable with it. That's really when you learn anything in life. That's what it essentially is. It's just repetition, conditioning through repetition, and doing it over and over and over again until you stop being nervous about it. You stop worrying about it, and you start to really focus on getting better and better each time. And then over time, you start to, you know, be able to do so effectively, if that makes sense. Same thing in trading. Very, very similar in trading. Again, Meta started bouncing back up a little bit. We're going to pull up the dollar index here as well. Okay. And see, I'm going to bring on my my friend in the mortgage industry. His name is Ben. Hey, what's up, Ben?
How's it going, man?
What's up, man? A little bit of echo on your mic. It could be if you have speakers playing on your computer and the audio is coming out of your speakers. One thing that you could do is you can mute anywhere you're watching the stream outside of StreamYard. That usually gets rid of the echo.
Okay, let me give that a shot.
Sure. Rate hike expectation, I think we'll do 25 basis points rate hike. The question is, what does Jerome Powell say afterwards? That's going to matter more so than, again, I think it's pretty likely we're going to do 25 basis points. We rarely deviate from expectations with the FOMC decision. So it's probably going to be 25 basis points. And I don't know, maybe it's just on my end, guys. Did y'all hear when Ben spoke? Did y'all hear an echo? It might have just been on my end, really. Yeah, in 40 minutes. You can see the timer on the top left. I think I did this clock this morning, so it might not be perfect, but we're there. 20 Swedish time. I heard, okay, yeah, so it wasn't just me. Yeah, generally, like I said, I used to do these a lot. If you watch the stream anywhere else, sometimes there's an echo on the devices. It could also be playing out of just the computer speakers in general. Like, so if I'm basically, if you think about it, if the speakers are playing and it comes out and the microphone picks up the speakers, that's what a lot of the time causes the echo. And again, we'll see what happens with Meta. Again, what I'm curious about is if this trickles into other social media companies as well. You know, the FTC talking about a proposed ban on content in that way. Could I take dip during meetings? So I'm assuming you're meaning like a dip buy. I mean, you could. But again, I have no idea if that's going to work out for you. We can look at Bitcoin as well. Here's Bitcoin. Here's Bitcoin futures, at least. Bitcoin currently at about 28.5. Hey, what's up, man?
All right. How's that? Any echo?
It's not too bad. It's not too bad. So yeah, I think that one's probably okay. What do you guys think, chat? It's good? Should be okay, I think. So yeah, so he is a mortgage broker here in Texas. And we have a video debuting after this stream about mortgage interest rates, and like, you know, there's a lot of different news stories about like low credit applicants and interest rates for them and how that affects higher credit applicants and stuff like that. So y'all stick around to after the stream. We're gonna debut the video. Okay, no echo. Good, Melanie. Nice. So yeah, Ben, so how do these rate hike decisions affect the mortgage market, I guess, is an interesting question to have. Like, is it gonna, like, okay, if, say, Jerome Powell raises rates 50 basis points, which is very unlikely, I think. I don't think he's gonna do that. But if they did, obviously that means mortgages are gonna get more expensive as well. Correct?
Yeah, if he did 50 basis points this time, there would be a knee-jerk reaction, and the bond prices, the MBS securities, they would go up quite a bit because everybody, as I heard you saying earlier, everybody's anticipating the quarter.
Sure.
But I don't think there's any chance this time for a 50 bip raise. I think that it's probably going to be the 25, but there's a slight chance. I'm thinking it might be 0.
Yeah, I thought originally, you know, if you know about Cramer in the last like year, the big joke is that Cramer has a curse. Everything Cramer says, the market does the opposite. And I saw a post about, it must have been one of the parody pages regarding Cramer that said Cramer was expecting a pause. And I was sitting there thinking, man, I don't know if that's going to happen. I think it's pretty likely we're going to do 25. Usually it's as expected, it's, you know, but if we do pause and Kramer's right about that, maybe that would break the Cramer curse. But it looks like that's not today. Cramer, it looks like it was just a fake post. Yeah, I see somebody say, or go ahead, sorry.
Yeah, I do think that there is a slight chance for 0, but it's almost definitely going to be 25. But you just always have to keep in mind that whatever the expectation is, that's already baked into the market. So everybody's thinking a quarter.
Right.
So if it is announced a quarter, then everything's just going to stay the same until like 30 minutes later when we read the minutes.
Sure.
But if it is a pause, it's going to be a pretty big move in the mortgage markets. And then if it is 50 bips, which that's not going to happen, it's also going to be a big move. Just when they go away from expectations, you know?
Yeah, so if we pause, would that mean that, and I saw somebody say that they're in Texas. Listen, hey, if you need a mortgage, I mean, you know, reach out to Ben at applywithben@gmail.com. If you need a realtor in Texas, I'm a real estate agent as well. And I'll put my information up in a second. But yeah, I'll have to find out the information. I'm going to put it up. It's John at inkedrealestate.com. I'm with Inked Real Estate. I think I have to put the text on screen, but I think I could also send a link. I do have a new website now. And forgive me, I just created this website, but it's johnlondon.info.com. And I'll put this link up. I guess I'll put this up in the description here. You know, with Trek rules, I got to make sure I'm following them. But yeah. So if we paused, that would mean mortgage prices are typically going to go down, correct? Or mortgage interest rates are typically going to go down, correct?
Yeah, but what we really watch, because rates don't change immediately, we watch the bond market, and the prices for each rate change immediately. So you just look at charts, and if there was a pause, which would mean a quarter different than expectations, that would probably mean a move from the expectation to, I don't know, 75 bips, something like that in the bond market.
Right.
Maybe even a little bit more, because then if it pauses and it goes against expectations, then they're going to start building in even more lenient policies as far as, you know, quantitative tightening or easy. Yeah.
Yeah. That makes sense. They're kind of a trickle effect into everything else and kind of start to ease into it a little bit more, prepare for that, I guess, moving forward if they do pause. You can see Bitcoin popped up to 28.7 thousand right now. And if we pull up the CME group statistics here, you can see we have about 88% of votes here on the futures website, basically, assuming that we're going to get 88.2% of people assume that we're going to get 25 basis point rate hike. And you can see it's from 500 to 525 basis points. You can see this is basically a pause because currently this is where we're at now. And if you want to look up, I always typically try to show this at least once on the stream, how you can look up where the data comes in. So if you go to this website, and I'm going to put the website up in the description as well, because this is how you find the rate hike decision. So I'll report it, and I'll probably report it faster than anybody here will be able to look it up. But if you want to know how to look it up yourself, this is how you do it. So here is the Fed website with the federalreserve.gov. You can Google this. It's the FOMC calendar. When you go down, here is 2023 right now. So you can see 2023 FOMC meetings. If you scroll down, you can see, let me find my pin. I thought I had a pin here somewhere. Let me find it. Oh, well. So I don't know where my pin is, where that lets me draw on the screen. But if you look here, so here's the last March meeting, the one that was on March 22nd. You can see the press conference video from that. You can see the minutes report, which was released April 12th. So typically, like the Fed minutes report is a PDF file that goes live at 2 p.m. that's generally released about 3 weeks after the Fed meeting. So every 6 weeks, the Fed meets. They determine how much they want to raise or lower rates. Again, today they're expecting 25 basis points. And then weeks after that, they release what's called the Fed minutes report, which is a PDF file. We can look at the last one here, and you can kind of click on this. But this is where all the data will be at 2 p.m. when it goes live. So if we scroll back here and we look at the last decision, I choose HTML because it generally populates a little bit faster. If you choose PDF here, it will take a little bit of time to download. But you can just go to HTML and you can scroll down and see that they decided to raise it from 4 3/4 to 5%. So that was 25 basis points last time. And so if you look at the watch tool here, you can see from 475 to 5 is the same thing. So 4 3/4 to 5. So basically, when you read today's, everybody at home, so when you read today's, if you want to see whether they're doing it, if they go from 5 to 5 1/4, that's going to be 25 basis points. If right here it says we're the target range for the federal funds rate from 4 1/4 to 4 1/4, that means pause, or they might just say we decided not to increase at all. In the report here, and again, you'll be able to find it at 2 p.m. right here. But again, we'll report this pretty fast as well. So just wanted to give everybody at home a way that they can look it up as well, and we did include that link in the description. Sorry, Ben, if I'm talking everybody's head off. I'm just kind of used to,
No.
kind of used to talking these things. Meta, man. Yeah, Meta. Yeah, look at Facebook today, man. Facebook is
I don't know if I'm doing that too.
Yeah, Facebook is dipping down really heavily today. They are, somebody in the FTC proposed banning child content completely on the social media platform. I don't know if they proposed it or if that's actually going to go through. But Facebook dropped from 241 all the way down to 233s, and then bounced all the way back to almost 240, right around the volume weighted average price. So yeah, big volatility there. I don't know how much it's going to affect stocks though. Let me see. Feed keeps freezing, so I think it's on your end, Ben. I can ask everybody at home. So I see your screen's freezing a little bit. I'm going with Kramer. Here, let me check. So chat, is it freezing at home? Get into crypto, folks. Yeah, Bitcoin's running up a little bit.
I mean, it could be capitulation or it could be the bull run.
Yeah. Bitcoin, it's had a little bit of a slump the last few days. It's at 28.6 thousand right now, but these are Bitcoin futures. But yeah, it has had a little bit of a slump the last few days. but it's been on a pretty big bull run all year this year. If you look at like 180-day chart, you can kind of see a lot of people, including myself, were really worried about Bitcoin back in November of last year when it was like 15,000. I thought 15,000 was a rough level to break under. And when we broke underneath that, we essentially haven't looked back since then. We're all the way back up to basically 30K now. I think as long as we hold over 25, we're doing all right. Okay, so yeah, Ben, if you could hear me, it says most of the people at home are saying that we're not lagging at all on the stream. It might just be you, man. But something else that might help is if you plug an Ethernet cord directly into the computer, usually helps for me.
Yeah, I'll get that going.
Yeah, no worries. I had Comcast, man. Comcast freaking sucks. I hate Comcast with a passion. Anybody on the stream knows that like Comcast is like my nemesis over here. They have scammed me so much. They'll tell me, hey, Comcast, they'll be like, yeah, you're paying $130 a month, flat rate, no fees after that, $130 a month. And so I'll say, okay, great. And then I'll get my bill the next month and it's like $300. And then when I call them and I'm like, hey, what the heck are y'all doing? Like, why is my bill up 100% relative to where y'all told me it would be? And they just deny ever saying it would be $130. Now we have
just an estimate,
Yeah,
just an estimate, but I think everybody does that.
Oh,
I think every company does that.
Well, no, man, listen, I got this new fiber optic company. It's called Takis, $90 a month, fiber optic internet. I get 1,000 up, 1,000 down, $90 a month, no contract. And so that's what I had installed here. I could also use it as a business expense, of course. But yeah, $90 a month, no contract, 1,000 upload speed, 1,000 download speed. So way better than Comcast. I felt so good to cancel them too.
Yeah, I just switched over to AT&T. It's all right. They're all the same.
Oh yeah, for sure. AT&T, DirecTV, I had them too. We recently switched and got all. We switched to the only problem is I can't watch the Astros games. That's my big issue, is that I could watch all the other games, and so now I'm watching Trout and Ohtani and Vladdy Guerrero over there at Toronto. But yeah. Watching the Angels in Toronto instead of the Astros now. But I use we have Fubo. Fubo actually is a stock, but I think Fubo has had a pretty bad couple quarters here, if I remember correctly. This one was really hyped up for a while, and they're great for sports. But I don't know if their consumer base was too small or what. Yeah, they've gone from like $8 a share all the way down to $1 right now. But they had great sports. They had all football games, most baseball games. So
yeah, I like their commercials where they're just throwing money at them.
Yeah.
Or was that Hulu or Fubo? I don't know.
I know exactly which one you're talking about. Yeah, it's one of those.
Yeah.
But yeah, somebody said my Comcast bill randomly goes up every year. I remember I was paying $125, now $500, same channels and everything. I'm telling you, a lot of y'all should switch to streaming. I have Hulu, YouTube Premium. I have Hulu, YouTube Premium, Netflix, Amazon Prime, and Fubo. So I have 5 different streaming services, and all 5 of those I get more content than I ever got on Comcast, and it's like $150 for all of them. And so, I think streaming's the future. I think over the next couple years, I'm surprised Comcast isn't down. Comcast had a good quarter. I can't remember what the stock for Comcast is, but it's CMCSA. So yeah, I remember they had good earnings when they just came out, but I'm surprised this chart's not worse than it is. But I guess they make so much money. I think the margins are so good in those businesses that it doesn't matter,
Yeah, they've got all these regional sports fees and broadcast fees and all that stuff. The streamers don't have all that.
Yeah, that's the big problem. And baseball's the hardest one hit. I can watch all the football. Fubo has NFL Red Zone and most of the local sports games anyway. But I'm a Saints fan, so I end up having to watch Texans games sometimes. But there's some workarounds to that. But it also comes with NFL Red Zone, and so baseball is really the one that gives you problems because of the blackout restrictions. So it's I can't watch an Astros game to save my life over here. I need AT&T or Comcast, and so.
Yeah, but keeping up with a baseball team is like a part-time job.
Yeah, so many games,
I
bro.
mean, that's
There's
a
so
lot
many
of games, you know?
Yeah, yeah. The new rule should help though with the pitch clock now. Never knew Comcast was in Texas. We have Spectrum here. Yeah, I'm from Louisiana originally. And when I canceled Comcast, that's how I got out of my contract, is because I knew where I was, my hometown in Louisiana, which is Baton Rouge. I knew they didn't have Comcast. And if you tell Comcast you're moving and it's to a place that doesn't have Comcast, they cancel your bill. And so I was just like, yeah, we're moving to Baton Rouge, and they were like, oh, well, let me look up if we have it in your area contract. Somebody's going to report me for that. Don't you guys do it at home. Maybe I shouldn't have even said anything. Prince says, why is your clock over a minute ahead? It's not. Yeah, I set this clock this morning. It's timed for about 2 minutes before the rate hike decision, which I'd probably prefer. Again, at 2 p.m., they're going to announce the rate hike decision. For those at home that don't understand the logic of these rate hike decisions, they raise rates. And when they say they're raising rates, they're raising interest rates. When they raise interest rates, the federal funds rate and interest rates, people stop spending as much because it's more expensive to spend. And so in turn, businesses lower prices to compensate for it. That's the logic of these rate hike decisions. And that's why they're so big in terms of market reactions. If inflation's really bad, theoretically, they raise rates really aggressively to combat that. And if inflation is getting better, which we have seen over the last couple months, Ben actually told me prior to the last CPI report, I think, which dropped, I think it was the last one. Ben actually told me, I think, that he thought CPI would be lower, and it was during the last one. We'll see what happens with this rate hike decision, but yeah, it'll be interesting. Markets will move more from the press conference, though, I think.
Yeah, when is that?
So it's at 2:30. So at 2 o'clock market time, so 2 Eastern time. So at 2 o'clock, they're going to release the rate hike decision on the site I showed earlier. It's in the description. And then at 2:30, Jerome Powell, Big Papa, we call him over here, will do the rate hike decision, or the press conference for it.
Yeah, those conferences, they have more of a potential to move the markets. I mean,
Sure.
Can you imagine just being up there speaking to the whole country, and if you get like one word wrong, like you say dovish instead of hawkish, and it like just sends everybody into a frenzy and the markets start going crazy or whatever. That's got to be kind of stressful for those guys.
Oh, and they don't even pay him that much. I talked about this earlier. Everybody hates Jerome Powell. Man, that is a hard job. It's not like he's the only member of the FOMC committee, but everybody acts like he is. And so any good news, they don't give him any credit for it. Any bad news, it's all Jerome Powell's fault. And he only gets paid about $200,000, which, I mean, I'm not saying that's not a lot, but for that job, where you're getting so much heat at you every day, I think it's a little small of a salary for him. But I'm sure he's making money, and he has a lot of other benefits there too.
I'm sure he's okay.
Yeah, yeah, he's doing fine. Who hates Jerome Powell? Oh, bro, if you're asking that, you don't watch these streams very much, man. Watch a stream where the market tanks from the rate hike decision, and you'll see. Everybody hates Jerome Powell during those days. Yeah, that guy's getting paid off the check and no tax. Don't feel sorry for him. He's making more than you think. Yeah, I'm sure he is. It's going to be very volatile. Take your boys and girls room breaks before the show starts. Get the popcorn ready. We'll see. I think we'll probably come in as expected. And as Ben said earlier, I think we're already baked into what happens right now. I think we're already baked into 25 basis points.
Yeah, and something else is the Fed is going to keep raising rates as much as they can. The Fed funds rate only. We're not talking about all rates, but it's just basically the cost that banks are charged to lend money between each other.
Sure.
That's the Fed funds rate. And then, yes, it does affect all other interest rates. But, I get a lot of clients sometimes that ask, I just saw that the Fed, raised rates a quarter. So that means, or, lowered them a quarter or whatever. So that means my interest rate should have changed, right? But going back to this was already baked in. That's why it doesn't directly affect everything.
Right.
But yeah, the last meeting, I think it finally hit about 5% CPI.
Yeah.
So, I was kind of thinking it was going to go down to about that level. But I think it's going to fall even further now, just because on this next meeting. This is just, I mean, if I had a crystal ball, I wouldn't be sitting in this chair. I'd be doing something else. But on the next meeting, if you look back like 12 or 13 months at the inflation charts, there was a big spike about 12 or 13 months ago. And so we're going to be replacing higher numbers with lower numbers, or I think I said that wrong. We're going to be replacing 12 months ago lower numbers with higher numbers as far as the cost of everything. So this is going to artificially send the inflation numbers down a little bit. So.
Okay, that makes sense. So yeah, so basically like they're looking at a trailing 12 month number. And so this next one, a high number is going to roll off. And so it's going to make the yearly CPI look artificially lower than it really is. I mean, it's still going to be that low over the last 12 weeks, but they're not taking into account the higher numbers that were slightly over 12 months ago, if that makes sense. So yeah, that makes sense a lot. So yeah, CPI is Wednesday. Wednesday we have the CPI report. So that drops at 8:30 in the morning, and then I think we'll have PPI drop the same week. Usually, we got a lot of stuff, man. These last 3 weeks have just beat me up in terms of work. It's just been so much stuff to cover. It's great for the channel growth, but this week alone, like tomorrow we have Apple earnings. We have Apple earnings tomorrow evening. We have jobless claims tomorrow morning. We have the European rate hike decision tomorrow morning. Friday we have non-farm payroll numbers, and we had the prelim non-farm numbers this morning. But yeah, Friday we have AMC earnings. We have unemployment data dropping Friday, and then we have non-farm payroll data dropping, which are all relevant economic data. And then next week we have CPI, PPI, more earnings, I think, as well. So just really busy time for sure. But great for economic movement. I haven't been buying up anything recently, though. I think we're just a little too high. The hedge on your farm is the best hedge. If psychology is a market force, I think the psychological confidence in the dollar is starting to roll over. Yeah, maybe. I mean, there's always an inverse correlation with the dollar in the market itself, So like today, the market pushed up recently. The dollar is around the lows of the day. So I wouldn't be surprised if Apple hits an all-time high tomorrow after earnings. Yeah, I mean, it's possible. I always try not to predict earnings because nobody ever knows. And for instance, every rate hike decision we ever do here, somebody in the chat's telling me the announcement was leaked. CPI, every CPI report, somebody's like, oh, the numbers were leaked. The numbers were leaked. And they always give me a completely wrong answer. So at this point, you would think they're actually it would be likely for them to eventually accidentally get it right. But the leak predictors are always wrong, even despite the probabilities of them getting it right at some point already. 12K in profit in 5 days. January 24 AMC calls. Yeah. Gold has been pushing up a lot. So gold is up to 2035s right now. The highs are like 2060s, I think 2060s. Hey Ben, where's your mic at? Let me see. So I can hear bumping on the mic.
So you can.
Yeah. So where's your mic?
It's by my keyboard. I should probably move it.
Yeah, I have a mic. If you need an extra mic, man, I can give you one. So Ben actually lives, he's a family friend of ours. I could give you a mic if you want one too. I have a blue snowball mic. I actually have 2 of these as well that I use if you want one.
Yeah, I've got that Yeti right here. Where is it at? There it is. Yeah.
Oh yeah, you have the same one. Yeti okay, yeah.
I probably just need to change the position of it or whatever.
Okay.
It's all good.
Yeah, no worries. Who wants to know how I made 12K in 5 days by risking 30K? Yeah, you can also mute it if you're not talking. That's another way. That's what I could do as well. See, you have a pop filter on yours though. I got one somewhere, but.
That's just for when I'm rapping, that's
yeah.
Not for really these.
Mixtape coming soon, guys.
Yeah.
Honestly, I said that to my daughter yesterday as a joke. And Maddie said, Daddy, they don't have mixtapes anymore. She's like, they just have Spotify now. And I was like, man, I'm old. Like, do they not have mixtapes
SoundCloud.
anymore? Yeah, you know, they don't even have mixtapes. Chat knows better than I do. When's it start? It starts in 12 minutes. The rate hike decision will be announced. You can see the SPY is actually dipping down a little bit right now. It's at about 4/12. So the actual rate hike will be in about 12 minutes. But the press conference, which is probably going to be more influential, is going to be in about 42 minutes or so. Let me do a Twitter post here. All right. All right, guys. So, yeah, SPY pulling back a little bit. We got about 1,300 people or so right now. Do me a favor, hit the like button if you can. I'm in a second. I'm gonna put it in sub only mode as well. Also, give me a follow on Twitter at Beginner Trades if you can. Okay. So look. So Carol's here over here. Everybody say hey to Carol.
Hey, Ben.
Oh, his mic's muted. Oh, there he is.
What's up? How you doing?
Good.
Yeah.
All right.
So the rate hike decisions today. So it impacts inflation, or it impacts market sentiment and interest rates and a lot of different things. So Jerome Powell is going to be talking today. Market's actually pretty high though. We have a little bit of like a cup and handle technical pattern forming, which is kind of there's my pin. So you can kind of see the little cup and handle. Here's the cup, and then here's the handle. I don't know if it's going to follow through, but I do like the fact that the VWAP and the 200 EMA are right underneath us. That's generally a good sign. But really, to be honest, none of it matters, because if the rate hike decision comes in anything outside of expectations, technicals are going to mean nothing really. Your wife's just like making up for Chanel. I don't think she likes Chanel. She's not a big Chanel liker, you know.
All right,
baby.
All
Love
right.
you.
Good to see
Everybody,
you,
thank
Ben.
Carol for coming on
All right.
stream.
Yes. Good to see everyone. Good luck, everyone.
All right,
baby. All right. Love you.
Love you. All right, so we're gonna put my fake fire on in the background if you guys can see it. Yeah, I mean, during these rate hike decisions, it's not gonna matter at all what technical levels are on the intraday chart. It's just not gonna mean anything. Yeah, it's all good. I appreciate the compliment, Arab. I get really weary saying words that I don't know the meaning behind, because you know, too many people have tried to trick me into saying curse words on stream, and I avoid it if I can. I mean, off stream I curse sometimes, but like on stream, we try to keep it family friendly here. It's nice. She takes an interest in what you do. Mine could care less. I mean, Carol, I love her. Great wife. She doesn't care about the stock market. She likes Lululemon stock, and so she'll kind of watch Lululemon stock. But in terms of like, I talk about the market all day, and she's a good wife. She listens, but I don't know. I don't know how interested she is in it. I guess here's a question. What do you think gold is going to do today? Usually gold moves inversely compared to like historically gold has been a hedge against inflation. And so people buy gold if they don't trust other, assets like the dollar. But gold has kind of been moving with the S&P 500, and it's been very strong recently. If you look up gold futures today, gold futures are currently at 2034. So 2034. So the highs are, I think, like 2066 or so over the last year. And this might be the lifetime highs. Yeah, or no, 2089. So gold hit the highs the last high in August of 2022. Gold hit almost $2,100. So it's at about 2,034 now. What do you think gold will do if we come in? What do you think gold will do if we come in at a 0 rate hike, Ben? Oh, hey Ben, what do you think gold will do if we come in at 0 rate hikes? I have no idea, honestly. I don't watch gold a ton. Chat might know better than I do here too.
Is my stream going okay?
It's been. I think you're lagging a little bit. I think the stream's running smooth. I think it's probably on your end. No to gold.
Can you hear me?
Okay, now I can hear you. Yeah, so you're chopping in and out. So some of the stuff you're saying, I can't. You're breaking up a little bit.
Yeah, I'll fix that.
How do we interpret the? Okay, yeah, no worries, man. It's all good. Yeah, pizza.
Pizza, and I got that pineapple teriyaki chicken.
I just ate.
Oh,
Yeah, I'm sorry. Thank you.
I got some.
Yeah, I might eat some later. Thank you. Love you. But yeah, the stream's running smooth. You just you're cutting in and out a little bit, but it's all good, man. It happens. I sold all my gold and bought the Q. So you're buying tech over gold. So here's the Q. Q is at 320.18s right now. 320.18s. Yeah, I mean, tech has been pretty strong. I know yesterday we had a pretty red day. It's all related to the bank failures. So like the banks have been struggling. In those bank struggles, the market has been weighed down from, because what happens is like FRC fails and then other banks are weak, and then it trickles into the larger banks like Bank of America, Wells Fargo, JP Morgan, Citigroup, the largest banks in the world. And so bank weakness has dragged the market down, dragged the market down. And so one of the interesting parts of yesterday, though, was that despite the market falling down pretty heavily all day yesterday, Amazon had a green day, and Amazon's green today as well. So Amazon, I think it could be based off of extension, though. If we look at Amazon had a pretty rough reaction to their last earnings report, where they went all the way up to 123s and then they dropped all the way down to 103s, 104s. And so that could be what this is all related to, is just rebounds from the really weak move from earnings. I could also put up the dollar index here if you all want to look at the dollar index, also known as the Dixie. The dollar index is at 101.40s right now. And again, generally there's an inverse correlation with it, because if the dollar moves, if somebody's sitting on cash and their cash gains value, they're going to continue sitting on that cash, so to speak, if that makes sense. If your cash is losing value, you're going to take it and you're going to put it into other investment vehicles like stocks, like real estate, like crypto. And so because of that, there's an inverse correlation there, as well as inflation kind of gives it that inverse correlation as well.
Well, I don't know if you can hear me, but what I was saying is there typically hasn't been a correlation between gold and the rate hike decisions, because, it's the rate hike has to do with them going down or economic instability, and both those have different effects on cash and gold. But if they came in at 0, probably tech companies and maybe crypto, there's a better chance that those would pump.
Right. Because of, better margins, I guess.
Because it's cheaper to yeah.
Yeah, that makes sense.
Cheaper to.
Here, you're breaking up a little bit here, so I can't hear. Chat, can you hear what he's saying? Maybe it's just me. Gold is crashing. Okay, now I think you resumed. But yeah, you were breaking up a little bit there. Bitcoin at 28,565, so 28.5K for Bitcoin. Yeah, he's breaking up a little bit. So the stream's okay with me. I think it's just his end, guys. Also, make sure you hit the live button next to the play button, team, if you haven't already. So So again, we're going to do a poll here as well. We still got about a couple minutes until the actual rate hike decision is announced here, guys. So stick around, a couple minutes still until the rate hike decision is announced. Looking at our poll numbers here, we got about 2,500 people here now. 45% think we're going to get a bullish reaction out of about 2,000 votes. 34% think we're going to get a bearish reaction. 21% think we're going to get a neutral reaction here. And so there's the timer, guys. We got about a minute and a half left. All right, guys, get ready. Bitcoin pulling back. SPY moving up a little bit over 412s. You can see Bitcoin on the right side here. I'm going to put the dollar index up here too. So we'll put the dollar index up. I'm going to put Bitcoin up on the right, and then we'll put gold up. And or we'll put the dollar index, Bitcoin up, and then the SPY on the left side here. All right, guys, we got 1 minute left. Again, make sure you hit the live button next to your play button to make sure you're caught up in the market. Again, we got less than a minute, guys. Less than a minute. Again, we got it ready. We are ready to look up this number here as soon as it goes live. Again, I'm also going to throw it in sub-only mode, so if you can, hit the subscribe button. We appreciate it. We are going to throw it in sub-only mode. You can see the dollar index is starting to break down. We got 20 seconds, guys, 20 seconds. Again, hit the live button next to the play button to make sure you're caught up on the stream. All right, here we go. 5 seconds. All right, so there's the release. Market is consolidating here. Down to 411.70s. Market is up to 413s here on this rate hike decision. Bear with me. Uh, 25 basis points. 25 basis points. 25 basis points as expected. 25 basis points as expected. Market's actually liking this. It's up to 413s, but yeah, they just came in at 25 basis points as expected. They raised it from 5 to 5.25. And so again, 25 basis points. The dollar index is falling down some. As we said, it would probably be as expected here. The SPY is ripping up, but 25 basis points is what we came in with today. As expected. Again, a neutral reading here, and the market has reacted neutrally to this. We are, up and down, but pretty sideways as we expected. What's going to matter more, and again, we will stream the entire press conference live. And I will put this up on stream. Stream live at 2:30 right here. All right, so yeah, 25 basis point rate hike. As we told you guys, they probably would. Yeah, 25 basis points as expected here. Put that data up on screen so you can see it. Easy money. Yeah, again, we'll see. The dollar index has fallen down pretty big. So the dollar index is down to 101.19s here, 101.19s. Bitcoin has moved up a little bit from it. It seems like the market, again, it is a neutral reading. So this is what they expected it to be. That's why I like every single rate hike decision. You always get people that are predicting all these different things. They're like, oh, well, it's going to come in at this. It's going to come in at this. Generally, it's as expected. Again, generally, it's as expected. So what's going to matter more so than this, because this is pretty expected. Everybody kind of knew this was going to happen. But what's more important than this is Jerome Powell's stance, his thoughts on the economy during the press conference that happens in about 28 minutes or so, 28 minutes. And so, again, we will stream the press conference live. Stick around. And again, so far the dollar is falling down, which is good. I mean, this is typically good. Let me put the rest of this up. And we are going to put the, we're going to change the title here. All right, so market's starting to turn down at 411s here. And again, as expected, I'll go ahead and read the report here. So if you guys want me to read the report, economic activity expanded at a modest pace in the first quarter. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation remains elevated. Remember, I told you guys they would say that because they say it every time. The U.S. banking system is sound and resilient. Tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain, and the committee remains highly attentive to inflation risks. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. In support of these goals, the committee decided to raise the target range for the Fed funds rate to 5 to 5.25%. The committee will closely monitor incoming info, assess implications for monetary policy, and determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time. The committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. That is basically what they said. And again, what's going to matter more is what he says during the actual press conference. The dollar index is moving up. It's at 101.25s right now. The SPY is at 412s or so, 412s. So yeah, y'all stick around. Let me catch back up on the chat. Yeah, now we wait on his thoughts in 30 minutes. He moves the market more than this, most likely. The speech is actually the most interesting part, and that's in about 25 minutes. I'll put a timer up here if you guys want to watch it to kind of count down to it. But yeah, we got about 25 minutes. All right, so yeah, as we thought, market's choppy, Bitcoin choppy, dollar index is broken down some, but the SPY is mostly staying flat so far. All right, 5.25 interest minimum on most loans. Yeah, well, like Ben said earlier, so it's not directly raising or lowering interest rates. It's raising the federal funds rate, which impacts banks and their margins. And so if they raise the federal funds rate, banks must in turn raise interest rates to combat that, if that makes sense, to help their margins, so to speak. That's how it affects it. So it's not a complete direct effect to interest rates in that way. It's more so, they're making it more expensive for banks, which in turn raise interest rates to compensate for it, if that makes sense. Right, Ben? That's right, correct?
Yeah, that's definitely right. And
Okay.
I have a live stream for the mortgage-backed security market, and
yeah. Oh, I think you're lagging, man. So yeah, Ben, if you're talking right now, hey, everything just lagged, so we didn't hear. I heard you said you had a. Oh no, it's all good, man. Yeah, I heard you say you had a mortgage stream, but then it cut out a little bit.
Okay. Yeah. I don't know if you can hear me now, but
I can
the
hear
same rate. The same rate costs a third of a percent in fees compared to about 2 hours ago or an hour ago. It just shot up. It's just not a big move at all. So
yeah, because it's as expected.
Yeah.
Yeah, I'm sure the mortgage companies. Yeah. I'm sure the mortgage companies kind of look at it in that way.
And now it's already back down, so to about even. It's pretty much flat.
Yeah, for sure. And yeah, guys. So again, stick around. Kim says, "Thank you again, John, for being here for us, getting all the info we need to trade." Hey, no worries, Kim. I appreciate y'all watching the stream. Again, we still got about 23 minutes. Again, don't go anywhere, guys, because what's going to matter more so than the rate hike decision. Again, Ben and I both told you guys what we'd probably get today, which is 25 basis points. Sure, there was a chance that we were going to pause. Unlikely. Most of the time, the way I always put it is like big money knows, and I'm following what big money says. Like big money are the ones that are making these estimates for the rate hike decisions. They have way more resources than I do. And so they are going to understand in a much more thorough way what the likelihood of a rate hike decision is going to be. And so if a large majority of the big boy banks are expecting a specific thing, I'm generally going to go with what they expect, because they are not dumb. They have great resources, because again, resources equal money. And you know, so that's what I usually go with. And I think that's what a large majority of people do as well. Market has bounced a little bit at the VWAP 200 EMA level. So the market did bounce a little bit. But yeah, if y'all want to check out one of my sponsors, I'm sponsored by a company called Top Step. They are a funded account program for futures. What they do is they give you a demo account and they test your skill. And if you can hit the target on that demo account while following their rules, they fund you between 50 grand up to 150K. They are a sponsor of mine, and so they pay me money, and I'm certainly biased in their favor. But I think it's so much cheaper to try these funded account programs and lose than it is to put up the money yourself and lose. And I think most traders are going to lose these funded account programs because most day traders lose. But that's kind of the point, is that if you want to day trade and you want to have limited risk, but still have some pressure, still learn to trade, still have the same benefits, if you pass the testing they give you, like they're going to give you a demo and test your skill. If you can hit the target on the demo while following their rules, they're going to fund you between 50 grand up to 150K with a 90% split. And so if you pass it, you get a lot of the benefits anyway. You get 90% of your profits once you're funded. If you fail it, which again, I think is most people, you're only down 140 bucks. And so again, most people are going to lose day trading. Don't let anybody tell you anything different. And this is just one of the cheaper ways to learn and get your foot in the door without taking on a lot of risk. And there's no PDT in futures, so you can day trade short, buy market, buy bid, sell the ask, but without restriction by the PDT rule. And so it does make a lot of sense. It's kind of what a lot of people are doing now. You can kind of see the funded account market shoot up over the last couple of years. And it makes sense. I wish I had it in the beginning, because I lost thousands when I first started. And I think I would have eliminated some of those losses by trying one of these. I'll put the link up in the description as well as in the comment section. Check it out. If you are not in tech, what are you waiting for? It depends. It depends on when you're entering it. The tech market, NVIDIA, AMD, we covered AMD earnings yesterday. There's just been a lot of volatility there. Just a lot of volatility. And so y'all just be careful. Again, I'm certainly, like, my TOS account's got, like, it's got 6 figures in buying power in it. I'm certainly green swing trading on this account, but I'm not taking any swing trades over. I've bought a couple things, but I'm not taking as large of size as I usually do, because I'm skeptical because of extension. I think there's a lot of stuff that's up big over the last 6 months that I'm a little skeptical in buying up, specifically tech. Like Amazon's PE ratio is like 100 plus right now. So just too expensive for me to buy it up. NVIDIA is up like 300% in the last 6 months. Too expensive for me. Maybe if we get some pullbacks, I'll buy some of that stuff up. But for now, I'm just kind of sitting on the sidelines there, I think. The guest is a mortgage friend of mine. And again, I'll put up his website here. So he is a mortgage broker here in Texas. And so if you're in Texas and you want to buy a home, he knows everything mortgage in Texas. You can check out the link right here if you want to check out any of his stuff. And we also have a video debuting after this stream that's going to detail, the new rules with regards to like credit, low income, or low credit score applicants and mortgages, and what the new rules really mean, because there's a lot of stuff floating around about it. So it's good to clarify that stuff. Gold and silver.
This is kind of interesting. Rates are down. Mortgage rates are down the equivalent of about 1/8 now. So maybe it wasn't baked into the market quite as much.
Interesting.
As they thought.
Yeah, so I did see some mortgage rate data drop this morning. I think I actually posted it on Twitter. Let me see. So I did post some of this stuff on Twitter. Let me see. So mortgages. Yeah, so the NBA 30-year mortgage rate dropped 0.05% this week, from 6.55% last week to 6.5% this week. So it dropped 0.05% weekly relative to last week. But that's the nationwide mortgage rate, so to speak. The 30-year NBA at 0.05% drop. So that's good. At least they're dropping a little bit.
Yeah, it's just kind of whipsawing.
Yeah, it's pretty. A lot of people are apprehensive to do anything right now with everything, and I'm sure kind of mortgages are the same. Just because a lot of people are sitting waiting for Jerome Powell to say something. They don't know. I think Jerome Powell's smart. He doesn't want to crash under his watch. And so I think a lot of people over the last year or two would have preferred him to just kind of raise rates super aggressively, like sustained 100 basis point rate hikes over and over again, and just kind of destroy the market and then play cleanup afterwards. And so a lot of people were yelling for that, kind of a rip the Band-Aid off scenario with inflation, kind of get it done, beat the market down fast, and then play cleanup afterwards, but get rid of the inflation first and foremost. He chose a more conservative approach, of course. He did kind of sustained 50. He did 50 basis point, 75 basis point rate hike.
Hey, I just want to let you know that was the fastest increase in history. So,
oh wow.
I mean, I might disagree a little bit. If you think he did it slow, that was the fastest increase in history about a year or two ago. So it could have been a little slower, a little more conservative in my book. And I'm sitting in the mortgage business and the real estate business, and we sure felt it. So
I bet, man. Yeah, no, I understand completely, man. It's all good, man. I understand completely. It did hurt a lot of things, and like if you look at the SPY, the market, it's been on a pretty big drop over the last couple years. But at the same time, like during the pandemic, it was just flying up. A lot of people thought that wasn't super sensical, with the market flying up. I think a lot of people are predicting a crash here. I don't know. I know the Fed last time they spoke said they predict a mild recession later this year. I don't know if I believe it. I mean, I think it's certainly possible. I hope it doesn't happen, but I also understand that like inflation is really, really bad. And so it might not be the worst thing ever if it does happen and causes, of course they want to do a soft landing. And so they want to basically what a soft landing means is that they're going to raise rates aggressively enough to curb inflation targets, but not so much to which it causes a recession. But yeah.
Well, yeah, earlier what I was talking about with the inflation data, I mean, that was what sends downward pressure on inflation, but there's still so much pressure up with the cost of housing because there's such a lack of inventory. And that's about like 40%. I think it's actually housing and travel costs are like 43% of that number. So that's sending.
No, you're breaking up now. Yeah, you broke up the last 7 or 8 seconds. You broke up, so we didn't hear the last part. We heard the thing about hold on, let me change the song. There you go. Wait, are you frozen again? Yeah, so I think his screen's freezing up. We have 18 months ahead of low inventory. Yeah, it makes sense. Most people call it bull, so it means for me to go short. Yeah, I'm a contrarian trader as well. Yeah, I mean, it depends on the definition. Like, definition of a recession is 2 consecutive losing GDP quarters as well as high unemployment, right? We've had 2 consecutive losing GDP quarters, but we haven't had super high unemployment. So that's the difference, and that's where the nuance of like whether we're in a recession or not is there. It's whether we've had high unemployment, which and we did have 2 consecutive losing GDP quarters, but we also bounced back pretty fast from that as well. Like we're still having positive GDP growth, at least month to month so far. Tesla chart looks horrible. Yeah, I mean, dollar index is sideways, SPY is sideways. It's not super unexpected though for this market to do this. Like, it's not super unexpected for the SPY to do this. You know. All right, guys, SPY at 412s, 413s, dollar index at 101.30s, Bitcoin at 28,725s. Manuel, I don't know, man. It's that AT&T internet, Ben. It's that AT&T internet, man. You know, again, look for Takis. I don't know what they're called. See if they have it in your area. It costs like $300 to get them to route the fiber optic lines, but so much better. Again, I used to lag all the time. If you guys remember, I ended up paying for business Comcast during the AMC squeeze because we were averaging, a lot of people was when the channel grew a lot. But my internet kept crapping out from Comcast. And so, I hate Comcast. Y'all will know me. I will rant about Comcast all day if y'all allow me to. Yeah, so he says he's trying to fix the internet right now. But again, guys, get ready. Yes, Starlink is an option, but he's got, again, Ben has a very nice house. So it might just be the internet that's in his area. It might just be AT&T. Starlink's a good option too. Yeah, we're not up a ton. I mean, relative to where we were prior to the report, we're pretty neutral here. So you can kind of see what we were doing prior to the report here. And again, see where we are now. Yeah, you can kind of see like we're right here. This is us prior to the report. So we're pretty sideways. Nobody make a joke about what that looks like. But yeah, we're pretty sideways there. Yeah, it was like that for a while for me, Adver. It was like that for a while. No crypto in Top Step. No, he said he's fixing his internet, so he's probably going to leave and come back is my guess here. And again, check out Top Step, man. Day trading these economic releases is pretty interesting. Again, I might day trade some. We're up today on Top Step's combine, so you can see we're up about 180 right now. And again, it really is useful. And again, most people are going to lose. They're a sponsor of mine. I'm biased. But again, it's so much cheaper to lose on Top Step. And if you pass the test, you still keep 90% of your profit once you're funded. And so it really is the best of both worlds. If you lose, you're only down like 140 bucks. You can reset for 100. If you pass it, you keep 90% of your profit. And so if you want access to leverage or trading, this is one of the best ways to do it. And again, most pro traders trade futures anyway. So again, check out the link right there. We got about 11 minutes, guys. 11 minutes before the numbers come out, guys. 11 minutes. We'll see. We need the Q over 324s. Yeah, market's looking good. Market's looking strong here. Again, we might trade a little bit of this in futures. Very volatile couple minutes, though, here. Gold and silver. So we can look at gold and silver here. Here's the dollar index. Here's gold. Or here's gold right here. So gold is slightly down. Silver, what's the silver symbol? I don't know what the silver symbol is. I don't typically trade it. But again, we got 10 minutes, guys. 10 minutes. Lots of puts expiring this Friday. Yeah, we got a lot of economic data, man. We got non-farm payrolls Friday, unemployment Friday, AMC earnings Friday, a lot of contracts and options expiring Friday. And so we are in one contract of the regular E-mini now. We have effectively scaled out of this already. You can kind of see the gains. We were up about 180 prior to this. We are now up about 250 or so. Depending on what this last contract does, we might get it up to 300 or so if we end up moving up a little bit. See, we get a little pop up here. I like the downwick pressure. There we go. All right, so I think I got out there in time. Yeah, so I did. So yeah, look, you can see we are up about 290, close to 300 on the day. Bought the dip. I'm not going to sit in anything super long right now, just because I think there's risk in sitting in things a little bit too long here. But Powell's speech is live in about 7 minutes. 7 minutes. Yeah, big pop up. We'll see what he does, man. Again, it'll be fun. We'll see. Honestly, these next couple weeks are just big weeks, man. We got just a lot of stuff. We got CPI next Wednesday. We've got unemployment this Friday. We got non-farm payrolls Friday, AMC earnings Friday, Apple earnings tomorrow, jobless claims tomorrow, the ECB rate hike decision tomorrow. Just a lot of stuff. mostly lost money these last few weeks. Well, the market's been kind of iffy the last couple weeks. Choppy is the best way to describe it here. So like the market's been a little choppy the last couple weeks. Again, we got 8 minutes, guys. 8 minutes. Bear with me, pun intended, while I look up something real quick. All right, so yeah, bear with me, guys, while I look up something real quick. Again, 8 minutes. Market's pumping up. I guess I could have held this, but it's all good. All right, look at SPY at 412s80s. All right, taking losses and yeah, trading's normal to lose. Um, how is AMC earnings a big thing? Generally, every AMC earnings report, we get about 10 to 15,000 clicks. You know, I mean, it's nothing like the FOMC meeting. Like this stream already, we've got about 20,000 clicks. We got about 2,500 people here live, but people watch it. That community's huge. You know, it's not going to move the market, but there we go. So that looks good. And yeah, guys, y'all be safe here in the markets here. Y'all be safe. So we are good. I'm about to get the music back up, so bear with me. And I got my new nice little realtor website here. So I do have my nice little realtor website. So again, if you want to check it out, I'll post this link up. Again, if you're in Texas right now, you need to buy or sell a home. I am a realtor in Texas. Even if you're not in Texas, I can kind of refer you. I referred somebody else to my aunt has their own brokerage, and my cousin have their own brokerage in Louisiana. Man, what is? And so, yeah, if you guys need a realtor, let me know. Obviously, the spike is starting. Gold just pumped. Yeah, if you look at gold here, I mean, gold's still down. It's again, right now we're sideways. Like everybody acting like this is some big crazy thing. Again, the Powell speech is going to influence stuff way more than anything moving right now. So like, yeah, the market's up a little bit ahead of it, but again, the Powell speech is just going to be so much more influential. It doesn't matter if that makes sense, guys. All right, so again, SPY's up to 413s, that is. Let me see if I got the thumbnail thing created. There we go. All right, guys, 4 minutes, guys, 4 minutes. All right, guys, again, 2 minutes. They're about 3 minutes, actually, but the SPY's starting to push up over highs. We're at 413s right now. Gold is dipping down in an inverse relationship to the market itself. All right, guys. So here we go. Get ready. Again, rate hike decisions coming pretty soon. We'll see what they say. Yeah, we're going to stream the whole speech live right here, guys. Don't worry. We're going to stream the entire thing live. You might say it underneath this. Interpretation is subjective, of course. It really depends on what they say, man. Again, it really depends on what they say. If he says inflation is high, it'll probably cause market drops. But again, I'm not guaranteeing anything. I have no idea what that's going to mean. Yeah, of course. And so again, guys, we got about a minute and a half here. Let me get this ready. All right, so we got the speech ready here, guys. We are ready for the speech. We got it up. We are waiting for it to start. Stick around. Waiting for the speech to start. Yeah, let me fix this so we can kind of put the chart up here. You can see it hasn't started yet, so don't worry, guys. It has not started yet. Put this up here so we can kind of watch Bitcoin too. We'll put Bitcoin up on this bottom one. I'll put this up here. And then we will try to put the E-mini maybe up in the corner. All right, so again, you can see it hasn't started yet. Technically, it's supposed to start about 20 seconds. All right, so here's the S&P right here. There we go. All right, so here's the S&P. All right, here we go. Sound check. Sound check. All right, so again, we are ready. Hit the subscribe button, hit the notification bell. I'm going to zoom in a little bit here. He hasn't said anything yet. Again, so you could hear the music just now. I just muted it, but you should have been able to hear the music. Nothing started yet. You can hit the sub button if you want to chat. And yeah, let's see what we get today, guys. No sound. Yeah, I mean the music's live. It's not playing yet. You know, it's not playing yet. Let me unmute it real. Yeah, it's muted right now. Or they're not saying anything yet, so just give them a second. Sound check.
Good afternoon. Before discussing today's meeting, let me comment briefly on recent developments in the banking sector.
Uh-oh.
Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode, and will work to prevent events like these from happening again. As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by a 0.25 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we are prepared to do more if greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Gina.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
So, taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. So the staff's forecast is so. Let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's so different people in the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
Rachel.
Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default? And what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint, I would just say this: it's essential that the debt ceiling be raised in a timely way, so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up,
Was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision yet.
Steve.
Mr. Chairman. Oh, thank you. Yeah, Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank, which talked about, the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about, that I recall anyway, about the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't it wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing. And I thought it was a good presentation. And as I said, did remember it. In terms of what we're doing, of course, I think banks themselves are many banks are now are attending to liquidity and taking opportunity now, really since the events of early March to build liquidity. You asked about the separation principle. Like so many things, it's very useful. But ultimately, it has its limits. I mean, I think in this particular case, we have found that the monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities. And at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
Mr. Chairman, I'm sorry. I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was, they're pointing out something that they're working on and that they're on the case that I'm not sure whether they mentioned, I think they did actually. They mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank and there are many other banks that are experiencing these things, and we're on the case.
Go to Victoria.
Hi, Chair Powell. I wanted to ask you, obviously, with the recent bank turmoil, we've seen multiple banks buy other banks. And I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry really since interstate banking, and before that even. It goes back more than 30 years. When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large size banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things. I think that's a positive thing. Is it a financial? So I would just say, in terms of JP Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role. So I really don't have a comment on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate. And I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So, but do you have any concerns about the fact that they're getting larger in general?
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law is it goes to the least cost bid.
Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that a tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. You know, when we've been raising interest rates, and that raises the price of credit, and that in a sense restricts credit in the economy, working through the price mechanism. And you know, when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and you know, we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving, you know, a sufficiently restrictive stance. But I think conceptually, though, we think that you know, interest rates will, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong, then if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way. The assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that they're listed in the statement, the obvious factors. That's the way we're going to be thinking about it. That's really all we can do. As I say, it does complicate. We have, you know, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and you know, we'll factor that into our decision making.
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made. That would mean we think we've reached that point, and I just think it's not possible to say that with confidence now, but nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting, and that's, you know, we're just going to have to, before we really declare that, I think we're going to have to see data accumulating and you know, make that, as I mentioned, it's an ongoing assessment.
A follow-up on credit, if I could you give us a sense of what the SLUICE survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLUICE on May 8th in line with our usual time frame. And I would just say that the SLUICE is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Go to Nick.
Nick Tamaros of the Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last two meetings, been seeing the effects of those moves, why did the committee feel it was necessary to keep moving?
Well, the reason is that again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time. And that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. So we really we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, what you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
As I mentioned, I would just say that this assessment will be an ongoing one. You can't with economic data. You can't. You've seen take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that that a few months of data will persuade you that you've got this right, kind of thing. And we have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably, you can calculate them many different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1-year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what many people anyway, would assess as the neutral rate. So policy is tight, and you see that in interest sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off, or possibly even at that level.
Thank you, Edward.
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
Would be okay with a prolonged 3%?
Let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process. I think we're going to need to stay at this for a while.
How does the other side of the mandate, the job side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You still got 1.6 job openings, even with the lower job openings number, for every unemployed person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation is running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Yeah.
Hi, Chair Powell. Matthew Boesler with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number anyway. In any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand really in the labor market. It's interesting, as we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. It wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems that to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet wages have been moving down. Wage increases have been moving down, and that's a good sign, down to more sustainable levels. So I think it's still possible. I think the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is. I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The committee also noted in March that wage growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures, and then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four, and many others. And you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in an expansion. So yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that, that wages are really the principal driver, because I don't think that's really right.
Great. Chris Rugaber at Associated Press. Well, you mentioned profit margins. Those have expanded, did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So I think as goods pipelines have gotten back to normal, so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins coming down as a result of a return of full competition, where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Michael McKee from Bloomberg Radio and Television. Can you tell us something about what your policy reaction function is, your policy framework is going forward? When you look at the economy at the next meeting, are you looking at incoming data, which is by definition backward looking? Are you going to be forecasting what you think is going to happen? Are you ruling out the rate cuts that the market has priced in?
I didn't catch the last part. Rolling.
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking at both, and it'll be the obvious things. It'll be readings on inflation. It'll be readings on wages, on economic growth, on the labor market, and all of those many things. I think a particular focus for us going now over the past 6-7 weeks now, and going forward, is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards, and is that having an effect on loans, on lending? And so we can begin to assess how that fits in with monetary policy. That'll be an important thing. We'll be looking at everything. Again, I would just point out, we've raised rates by 5 percentage points. We are shrinking the balance sheet, and now we have credit conditions tightening, not just in the normal way, but perhaps a little bit more due to what's happened. And we have to factor all of that in and make our assessment of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging, but we will make our best assessment, and that's what we'll be thinking.
What about the idea of rate cuts?
Yeah, so we on the committee have a view that inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate to cut rates, and we won't cut rates. If you have a different forecast, and markets have been from time to time pricing in quite rapid reductions in inflation, we'd factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down. Particularly now, if you look at non-housing services, it really hasn't moved much, and it's quite stable. And so we think we'll have to demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
Courtney?
Courtney Brown from Axios. I'm curious how you view the role of the overnight reverse repo facility in the context of the current banking stress. Do you think it's contributing to the stress by making it more attractive for money market funds to compete with banks for deposits? And did the committee discuss any changes to the structure of the facility, or do you see that being put on the table in the future? Thanks.
Sure. So we looked at that very carefully, as you would imagine, and it's really not contributing. We don't think now. It hasn't actually been growing. It moved up, it moved down, and then moved back up to where it was. What happened in the when there were the big deposit flows, which by the way have really stabilized now. What happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the Federal Home Loan banks and things like that. Over the course of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had any effect overall on over the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
Sarah.
Sarah Ewall-Weiss, CBS News. I want to go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country, the markets, and borrowing?
Yeah, I would just say it's. I don't really think we should be. We shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't be a thing. And again, I would just say we don't. No one should assume that the Fed can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict.
Scott.
Thanks, Mr. Chairman. Scott Horsley from NPR. In his report last week, Vice Chair Barr identified a couple of the factors that he thought contributed to the regulatory, the supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift towards less aggressive oversight. You were here in 2019. Do you share that view? And what would it take to get the stronger oversight that you and he said in your release would be necessary?
So I didn't take part in creating the report or doing the work, but I have read it, of course, and I find it persuasive. I mean, I would say it this way. A large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system. I think the only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that it may just have been technology evolving. We have to keep up with all that, but some of it may be our policies and supervisory and regulatory, whatever. Well, what our job is now is identify those things and implement them. And that's kind of the only thing I care about and I feel like I am accountable for doing everything I can to make sure that happens.
Evan.
Thank you. Evan Reiser with MNI Market News. Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
So, I guess I would say it this way. There were three large banks really from the very beginning that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period of, is an important step toward drawing a line under that period of severe stress, okay? I also think we are very focused on what's happening with credit availability, particularly, with what you saw in the beige book, and you will see in the SLOOS is small and medium-sized, small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, we will continue to very carefully monitor what's going on in the banking system, and we'll factor that assessment into our decisions in an important way going forward.
Greg?
Thank you, Fed Chairman. Greg Robb from Market Watch. I just wondered if you've done any reflection on your own actions during this crisis and leading up to it over the last, since you've been Fed Chairman. I think I've heard you say a couple of times that you deferred to the Vice Chair for supervision. Do you think that was the right way to go about this? And yeah, comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations. And I do feel that I'm personally accountable to do what I can to foster measures that will address the problems. So on the Vice Chair for supervision, the place to start is the statutory role, which is quite unusual. The Vice Chair, it says, shall develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair, as Vice Chair for supervision, who really gets to set the agenda for supervision and regulation for the Board of Governors. Congress wanted that person to have political accountability for developing that agenda. So the way it works, the way it has worked in practice for me is I've had a good working relationship. I give my counsel, my input privately, and that's, I offer that, and I have good conversations, and I try to contribute constructively. I respect the authority that Congress has deferred on that person, including working with Vice Chair Barr and his predecessor. And I think that's the way it's supposed to work, and that's appropriate. I believe that's what the law requires. And, but it isn't, I wouldn't say it's a matter of complete deference. It's more, I have a role in presenting my views and having an intelligent discussion about what's going on and why. And that's my input. But ultimately, that person does get to set the agenda and gets to take things to the Board of Governors. And really, in supervision, has sole authority over supervision.
Just wondered if you had any regrets, or was there anything that, decisions that maybe you regret now in light of what's happened?
I've had a few. Sure. I mean, who doesn't look back and think that you could have done things differently? But honestly, you don't get to do that. Again, my focus is on control the controllable. As one of my great mentors used to always say, control the controllable. What we control now is make a fair assessment, learn the right lessons, figure out what the fixes are, and implement them. And I think that Vice Chair Barr's report is an excellent first step in that, but we've got to follow through.
Great. Thank you.
Hi there, Megan Casella with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously was that considered? I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again, or what those discussions entailed.
So support for the 25 basis point rate increase was very strong across the board. I would say there are a number of people, and you'll see this in the minutes. I don't want to try to do the head count in real time, but people did talk about pausing, but not so much at this meeting. There's a sense that we're much closer to the end of this than to the beginning. That, as I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're getting close or maybe even there. But that, again, that's going to be an ongoing assessment, and we're going to be looking at those factors that we listed in to determine whether there's more to do.
I'm curious too how to interpret that and the changes to the statement. Is the bar higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the Fed to tighten again?
I don't want to. I couldn't really say. I just think I think we've moved a long way fairly quickly, and I think we can afford to look at the data and make a careful assessment.
And we'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. You mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right lessons. What are those lessons?
Well, I just would start with something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history. And that now needs to be reflected in some way in regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that that will play through. It will be up to Vice Chair Barr to really take the lead in designing the ways to address that. But I think that's one thing. I guess I would just say that then that we're going to revisit. It's pretty clear to me anyway. It's clear that we need to strengthen both supervision and regulations for banks of this size, and I'm thinking that we're on track to do that as well.
Can you be any more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy?
Yeah, that's what Vice Chair Barr's role really is, and he'll take the lead on that.
Okay, thank you.
Thank you.
All right, guys. Well, that is the end of today's rate hike decision. Let me know what you guys think. Yeah, again, who was I talking to? Tom, it's all good, bro. Again, you got to understand this. Number one, guys, I'm flat. I said it many times before. It's not like I'm like super long. In fact, I said it many times. I'm not really buying up anything because I'm not super confident that we're going to keep going up, to be honest. And so, honestly, I'm kind of right there with you, Bears. Like, I get it. I understand completely. But I think we also have to take a look at the actual market right now. Okay, so if we look at the SPY here, the SPY's still above yesterday's lows. If we look at a 20-day chart, the market's pretty flat. It's not like this is the end of the world yet. Now, maybe what he said could mean we're going to drop. But again, typically the people who are shaming and making fun of other traders are just typically insecure about their own positions. It's just something that I noticed a long time ago. And so I guess the point is, let traders be traders. Don't make fun of them. Again, the market's been ripping up over the last 6 months. You know what I mean? So it's like, again, be confident in your own positions, but don't be so insecure about them that you're making fun of others. Like, that's usually not the right move. Again, that's usually either somebody that's really young or somebody that's insecure about their own positions. And again, we'll see if the market holds, guys. We'll see if the market holds. We're going to pivot to a real estate video. Before we do that, though, check out Chart Prime. We got 2 sponsors here, guys, and we plug them regularly. All right, one of the sponsors is a company called Chart Prime. It's a trading view indicator service that you could use in stocks, crypto, forex, futures. I love using these. If you look at my favorite time frame to use this is a 1 hour time frame, and you see they give you custom reverts and signals. Look at how accurate these are. I can't even fake this. Look at how accurate these are. Again, I'm biased in their favor because they pay me money and they're a sponsor of mine. But look, reversal down, drop, reversal down, drop, reversal up, literally called the bottom, reversal down, drop. This one was wrong. This one literally called the bottom. So out of 1, 2, 3, 4, 5, 6, only one of them was wrong. So pretty accurate. If you want to check it out, it's $35 a month if you use my link. Great way to help support the channel. You can find the link in the description. Also, check out Top Step. One of the ways you can trade some of this volatility is through a funded account program like Top Step, where they give you a demo. If you can hit the target on the demo while following their rules and conditions, they fund you the same amount. Great way to test your skill without taking on a lot of risk. There's no PDT in futures, and you can day trade the S&P 500. And so again, if you want to check it out, here's the link. Great way to help support the channel. Great way to help support the channel. Check the link out. Yeah, it's all love here, Tom. It's all good, man. Like I said, it's all good, bro. It really is all good, man. Hope you have a good day, dude. But yeah, guys, good luck. Again, we're going to pivot over to the real estate channel that we got going on. So we have a real estate channel. Let me make sure this is live. Again, don't go anywhere. If you wanted to know, like, I know there's been this big news circulating in the market about how, you know, somehow it's going to be low. We're going to have, somehow we're going to have to pay higher for mortgages than lower income or lower credit score people. That's not true. We've got some clarification on that. I spoke with Ben earlier, a mortgage buddy of mine. And so again, we do have some clarification in that regard. And yeah, it makes sense. So just stick around, guys. We are going to be premiering that video. You won't have to go anywhere. Again, as soon as I close this stream down, it's immediately going to bring you to this new stream. So again, I'll hit the let me make sure this is loading here. It should be loading. Let me make sure. And again, as soon as I end this stream, it should immediately bring you to this other stream. It should be about to start now. But yeah, guys, check out Top Step. Check out this link. Let me make sure we're getting this right here. Where's my page? There it is. And again, I appreciate the love, guys. I appreciate the support. Let me know what you guys think the market's going to do. Again, hit the subscribe button. We're a completely free trading community. Yeah, we made up, guys. You know, Tom and I are just bestest buddies ever right now, dude. It's all good. Again, y'all have a good day. Hey, thank you, Tom. I appreciate you, brother. Hey, like I said, I don't mean to be too hard on you, bro. Number one rule here is just don't pressure other people to do anything. You know, it's all good, though, dude. I appreciate the support, brother. Again, as soon as I close this stream, it's immediately going to bring you to our next channel, which is my real estate channel, guys. Ow! Damn, dude, that is loud. It's immediately going to bring you to my real estate channel. And so again, when it brings you here, hit the subscribe button. It's going to bring you to my real estate channel. Again, if you need a real estate agent, I am a realtor in Texas. I don't know how many of you guys are in Texas, even if you're not in Texas. All right, if you need a real estate agent, I'll post the link here. You can check out my link. And again, we're going to be debuting the video. It's johnlondon.info. Johnlondon.info is the website. Again, you can email me at john@inkedrealestate.com. And again, as soon as you go to the real estate, even if it's just a way to help support your boy here, hit the link. There's the link right there. And again, as soon as I close this stream down, it should bring you to this new channel. I'm just trying to make sure it does first. So bear with me, guys, while I check this real quick. Bear with me, guys, while I check this real quick. I want to make sure as soon as I close this stream, it should bring you to that video. I want to make sure it does. So bear with me here, team, and you'll be able to watch this video. And yeah, stick around. Again, it's going to talk about, okay, yeah, so we're good. All right, guys. So yeah, I'll see you guys over at this other video that we are watching. It should be right now. So the video is live right now. It should be starting very soon. So I'll see you guys over there.